All right, let's talk about investing. In a world where you're just bombarded with market news and super complex advice, it's so easy to feel like you're just guessing. But what if you could cut through all that noise and get real control in just 30 minutes? Today, we're going to build a simple routine that puts you right back in the driver's seat.
It's that nagging question, right? It keeps so many of us up at night. You set a plan, you're putting money away, but with the markets going up and down all the time, how do you really know if your strategy is still working? That kind of uncertainty can be absolutely paralyzing.
Well, here's the good news. You don't need a PhD in finance or to spend hours glued to financial news to stay on track. The key, really, is a simple, powerful, repeatable checkup. So let's walk through a process that will turn that anxiety into actual, genuine confidence and control. So first things first, why even bother with a checkup? Well, think of it like preventative care for your portfolio. It's about making sure your long-term financial plan stays healthy and, pointed in the right direction.
A quick look, just once a quarter, is incredibly powerful. For starters, it makes sure you're not accidentally taking on way more risk than you signed up for. It also helps you spot these little costly problems, like sneaky high fees or a fund that's just not pulling its weight, before they grow into big, hairy monsters that do real damage to your returns.
Okay, so let's get right into the 30-minute routine itself. And listen, this isn't about complex financial modeling or confusing spreadsheets. It's just a simple ritual, really, designed to give you maximum clarity in a minimal amount of time.
So here's the roadmap for our checkup. It's just 7 steps. We're going to start with the big picture, your allocation, and then we'll zoom in on performance and costs. We'll make sure the basics are working, like contributions and dividends. Check if any major life changes mean you need to shift your strategy. And then, this is the most important part, we end by setting just one simple, actionable task.
All right, let's pop the hood and get into the heart of the checkup, the vital signs of your portfolio's health. And honestly, the single most important vital sign is your asset allocation, that mix of stocks and bonds you decided on way back when.
Now, this is where it gets really interesting. This chart shows how your portfolio can change even when you do nothing at all. Let's say your target was an 80-20 stock-to-bond split. Well, if stocks have a great year, you might look up one day and find you're actually at 87% stocks. That's what we call allocation drift, and it means you've unintentionally taken on a lot more risk.
Now, a 7-point drift might not sound like a huge deal, but this chart shows the real impact. You've gone from the risk level you were comfortable with to one that's way more aggressive. This is exactly what a quarterly checkup is for. Catching this before a market downturn hits you 7% harder than you ever planned for.
Next up, performance. And you don't need to be a Wall Street wizard for this. You just compare your funds to a benchmark, which is basically just a yardstick, like the S&P 500 index, that we use to measure performance. So as you can see here, Index Fund Y is tracking its benchmark almost perfectly. But Active Fund X, it's lagging by 2.5%. If you see a fund trailing its benchmark by 2 or 3% for 3 years or more, that's a major red flag.
And that brings us to fees. These things are like a silent drain on your returns that just gets worse over time. The key number to look for is the expense ratio, which is just the annual fee of fund charges. For your big, core holdings like a broad market index fund, if you see that number is higher than 0.20%, it's definitely time to ask if you can find a cheaper alternative.
Okay, finally, we'll do a quick scan of the basics. First, are you on track with your savings goals for the year? Second, is your investment income, like dividends, being put back to work for you automatically? And third, has anything big changed in your life? A new job, a plan to buy a house? That might mean your old strategy no longer fits your new reality.
Okay, so you've checked your vitals and you've found a problem. Maybe your allocation has drifted way off course. Now what? This brings us to the next big step. How to take smart, effective action without overcomplicating things or creating a big tax headache for yourself.
This is one of the most common questions investors have. You see the drift, but, pulling the trigger to fix it can feel a little intimidating. Do you do it every time it's off by a tiny bit? Do you wait? Let's see what the evidence suggests. There are 2 really simple, effective triggers. The first is a drift threshold. A common rule of thumb is to take action when any major part of your portfolio, like stocks or bonds, moves about 5% away from your target. The second is just a simple calendar check. You review it every quarter, but you only actually make a trade maybe once or twice a year, unless that 5% drift happens. This whole system is designed to prevent you from overtrading. Now, how do you do this smartly? Well, in a regular taxable account, the goal is to avoid creating unnecessary taxes. So the absolute best way is to use your new contributions. If your stocks are overweight, just direct your next few investments into bonds until you're back in line. It's simple, and it triggers zero taxes. Now, selling your winners is faster, but that can mean paying capital gains. So always think tax first.
To wrap all this up, let's build your final toolkit. This is your cheat sheet for spotting trouble and for identifying some quick wins to improve your financial health right now.
Here are the 3 big red flags this whole checkup helps you catch. First, high costs that are just eating away at your returns. Second, a fund that is consistently underperforming and not pulling its weight. And third, and this might be the most dangerous one of all, making emotional decisions based on scary headlines instead of sticking to your actual plan. Feeling a little overwhelmed? Don't be. Here are some incredibly simple but really high-impact wins. Bumping up your savings by just 1% can make a massive difference over time. Making sure your dividends are automatically reinvested is a totally free way to compound your wealth. And, simplifying your portfolio down to just a few low-cost funds makes this whole process even easier.
This right here might be the single most important piece of advice in this entire explainer. The whole point of this checkup is not to constantly tinker with your portfolio. It's to identify one thing that needs a little attention, fix it, and then, and this is the hard part, step away. You have to resist that urge to overmanage.
So that brings us to the final, crucial point. After going through this process, what is the single, small step that you're going to take? Is it rebalancing? Is it swapping out a high-fee fund? Or maybe just bumping up your contribution rate? Decide on that one thing, and you'll be on the path to becoming a more confident, more disciplined, and ultimately a more successful investor.